Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by Marc Ostwald, strategist at ADMISI. OPEC meeting today, Vienna, everything priced in, no shocks. Can we move on, or what do you make of what's going on?
I think there's been the usual sort of posturing which goes on, and there's a lot of market manipulation by OPEC themselves and indeed obviously by the non-OPEC producers. So it looks like the deal is going to cap Nigerian and Libyan output, which includes them in where they'd previously been given an exemption. It will be extended for 9 months. Now the key in all of this is actually, so when I say it's extended for 9 months, from the current March end date to the end of next year. Now the key in all of this is actually going to be where the contingencies lie, i.e. how much they explicitly suggest that if the oil market is in better balance by May, June next year, when the next ministerial meeting is due, and suggest that they would review the production cap then, or they suggest implicitly, obviously we need to take the context of the market in view and we wouldn't want to leave the market short, which is a slightly different way of saying exactly the same thing, but there's one almost sets up the May-June meeting as, oh well, actually we've done our job, and I think there would probably be a more of a sell on the fact reaction from the oil market today. I think the other thing which is interesting in all of this, because there seems to be again a bit of manipulation going on here, is there seem to be a lot of people presuming that next year we'll see a fall off in demand for oil, which when one's looking at the global economy, the fact of the matter is we could easily have 4% global GDP next year. That follows on from 3.6 this year. We were languishing in the low threes for quite some time. Pretty much all the surprises on growth, bar India, this year have all been on the upside, including China. We may be worried about where China's going with its deleveraging, but let's put it bluntly, the MBS PMIs today were all very positive.
It's been a very good year for China.
Yeah. And as much as we can talk about electric cars, we're still a long, long way off from them being commercially, in terms of mass appeal, going to be produced, and that therefore we still depend very much on the combustion engine. And if global growth is going to continue to be strong, then things will need to be transported around. So I rather suspect that this assumption that oil demand is going to be lower, than it has been this year is probably wrong. So we're probably still looking quite positively balanced for the US. I think also we're starting to see a little bit of a shift in the narrative on the US shale production, and namely that is people keep on going, well, US production will carry on growing ad infinitum because it's cheap. I think that narrative has partly gone, because I think above all in the financial sector, this idea of just pump as much as you can and we'll finance it has gone a little bit by the wayside, particularly after the shock of 2015, early 2016. And so there's been a lot more emphasis in terms of the willingness to finance this, finance the growth of shale production, on how much are your returns going to be, because we haven't got bottomless pockets and we actually want to see your margins improving a lot more, which in turn means that some of the oil fields which may be being looked at for development may not come on stream as quickly as people are assuming, and therefore if we do have better global growth, then production probably for the time being will probably get into better balance with the surplus of inventories, and so you're looking at a situation which I wouldn't say is necessarily hugely bullish for oil, but is certainly a lot more positive than I think most of the skeptics would have us believe now. That's not to say that there isn't a correction possible, but it's just basically saying that once we've had a correction, and particularly we could sort of go into December if we get the right sort of noises out of OPEC. December is traditionally a big drawdown month, so if we actually see a decent drawdown and basically the surplus being eaten into, then you probably see a positive start to the year for oil next year.
And just finally, we were talking about kind of production or production cuts or caps, let's say. What about exporting? What are these countries doing, or what is OPEC and maybe non-OPEC to some extent to prevent exporting? Because a lot of these countries have reserves; they can export to their heart's content, especially if they're happy with a price above $60.
Yes, and I think that's a very, very thorny issue, particularly for the likes of Russia. However, I think the real issue with the whole exporting touches on something else which is perhaps more important in the context of the current context that we have of central banks starting to step away from the table. If we assume that they're going to gain more and more petrodollars from their exports, perhaps we need to consider what's actually going on in Asia. You're seeing the composition of imports from various countries starting to change quite dramatically. Russia has replaced the Middle East in a major way in terms of China. And there are certain countries which are also changing the composition there. So that means the pool of available petrodollars is probably not going to be as big. And in that context, as the Fed steps away from the table and the private sector is asked to take up, and when I say the private sector and those with large FX reserve surplus, which includes the oil producers, are going to be asked to step up to the table to buy more US Treasuries. And we must remember the US is very much dependent on foreign financing for its very large budget deficit, which may get even larger if we have this tax cut plan put through. But if we're actually in a situation where it's accruing to countries which are almost being excluded at the moment, as we know, Russia is very much being excluded from the global financial system, perhaps we need to have another look at the US budget deficit in a rather more serious way and ask whether, aside from Saudi Arabia, which has almost seemingly become a US vassal state with all the agreements they've got on defense spending, whether others are going to be as willing, particularly China, to finance the US budget deficit as they have been, particularly with the US at the moment blocking China's being declared by the World Trade Organization as a free market trading nation. So there are a lot more complex issues to do with oil, which I think people need to think a lot more hard about and long about, because they will have consequences next year. And as we see oil prices, if we do see oil prices rise, I should make that more of a contingency, and we see bigger surpluses, we shouldn't naturally assume that that means it will fuel a bigger demand for the US dollar.
On that note, Mark, thank you very much for joining us today.